The IRS increased the standard deduction for older taxpayers in 2026 to $16,550 for single filers and $3,300 for married couples filing jointly. However, they also updated how the home sale exclusion interacts with that deduction. If you sell your home this year or next without understanding the updated calculation, you could miss between $3,200 and $11,400 in potential tax savings you may have expected. That represents real money. It is not theoretical. It could be the difference between preserving your savings and paying additional taxes to the federal government that might have been avoidable with better planning. Some of these details are rarely explained in simple terms, and most tax software used each April may not always highlight the interaction clearly. So here is one key point to understand today. If you are 55 or older and you own a home, it is important to know that the $250,000 home sale exclusion under Section 121 of the tax code has not changed in its dollar amount. But the way your adjusted gross income may interact with other tax calculations can influence how certain benefits and thresholds apply in 2026. This interaction can affect how much of your Social Security income is subject to tax under existing rules. It can also influence the income levels used when determining Medicare Part B premium brackets and eligibility for certain state-level tax relief programs. These effects can occur automatically as part of standard tax processing once a return is filed. In this video, you will learn how a home sale can connect with Social Security taxation rules, which forms are commonly involved in reporting the transaction, and several steps that may help you review your situation before the end of the tax year. Government agencies such as the Social Security Administration or Medicare generally do not contact individuals in advance regarding these interactions, which is why understanding them can be helpful. Let's walk through how the process works. Once you see the mechanism, it becomes easier to understand why some retirees are surprised by how these calculations affect their overall tax situation. When you sell your primary residence and have lived there for at least 2 of the previous 5 years, the IRS allows you to exclude up to $250,000 of the gain from taxation if you file as a single taxpayer, or up to $500,000 if you file jointly with a spouse. Many people are familiar with this rule. Because of that, some homeowners assume the profit from selling their house completely disappears from their tax return. In practice, the transaction can still appear in reporting documents. A simple analogy helps illustrate this idea. Imagine going to a grocery store where the first $250 worth of groceries is free. You fill your cart and leave without paying. However, the store still records everything placed in the cart because that information is used in another system that calculates discounts, loyalty points, or membership benefits. Even though the groceries were free, the transaction still influenced other calculations. Something similar can happen with a home sale exclusion. While the gain itself may be excluded from taxable income, the transaction can still appear in reporting forms. For example, the gross proceeds from a real estate sale are commonly reported on Form 1099-S. When the IRS determines how much of your Social Security benefit may be taxable, it uses a formula based on your adjusted gross income plus certain other amounts such as non-taxable interest and 1/2 of your Social Security benefits. Because a home sale affects the broader financial picture reported on a return, it can sometimes influence where that combined income falls relative to existing thresholds. For 2026, those Social Security taxation thresholds remain the same as in prior years. They have not been indexed to inflation since the rules were originally established decades ago. Under current law, if your combined income as a single filer falls between $25,000 and $34,000, up to 50% of Social Security benefits may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, the ranges begin at $32,000 and $44,000 for those same thresholds. These numbers were established many years ago and remain unchanged today. Because home values have risen significantly in many areas since 2020, some retirees who sell their homes find that the surrounding financial activity reported on their tax returns moves their income close to or above those levels. Tax reporting and review procedures also continue to evolve. The IRS periodically updates processing guidelines related to capital transactions reported on forms such as Form 8949 and Schedule D. These updates are part of routine compliance efforts designed to ensure that reported transactions match information submitted by financial institutions and other reporting entities. These systems generally rely on automated matching rather than increased auditing. When a discrepancy appears between information reported on a tax return and information provided by third party forms, the IRS may send a notice requesting clarification or adjustment. Notices of this type are common within the tax system and often involve documentation or corrections rather than penalties. To understand how these interactions can affect individuals, it helps to look at simplified examples. Consider Margaret Dawson, who is 71 years old and lives in Dayton, Ohio. Her husband passed away in 2023, and she has been living alone in the house they purchased together in 1998 for $142,000. Last year, she sold that home for $310,000 because maintaining it had become difficult. She moved into a smaller apartment afterward. Her estimated gain from the sale was about $168,000, which is below the $250,000 exclusion limit for a single filer. Because of that, the gain itself was excluded from taxation. Margaret also receives $1,140 per month in Social Security survivor benefits, or about $22,080 per year. She has a small pension from the school district where she worked as a cafeteria manager that pays approximately $6,300 annually. In addition, she earns around $100 each year in savings account interest. Before the home sale occurred, her combined income was roughly $28,140. That level placed her within the range where part of her Social Security benefits could be subject to taxation under the existing formula. During the year the house was sold, however, the overall reporting on her tax return temporarily increased the financial activity shown in her adjusted gross income calculations. As a result, the formula that determines how much of her Social Security income is taxable produced a different outcome for that year. Situations like this illustrate why understanding the interaction between various forms and thresholds can be useful when planning a home sale during retirement. Now consider another example involving Richard and Carol Briggs. They are 66 and 64 years old and live in Mesa, Arizona. They purchased their home in 2004 for $189,000 and decided to sell it in early 2026 for $415,000 so they could move closer to their grandchildren in Oregon. Their gain from the sale was about $226,000. Because they filed jointly and the exclusion for married couples is up to $500,000, their gain was fully excluded from taxation under Section 121. Richard currently receives Social Security benefits of about $1,690 per month, while Carol has not yet claimed hers because she plans to wait until age 67. Richard also receives required minimum distributions from his traditional IRA, which total about $13,200 annually. When their other income sources, such as annuity payments and interest, are included, their combined income before the home sale activity was around $41,500. That level placed them near the threshold where the maximum percentage of Social Security benefits may become taxable under current law. When reporting the home sale on their tax return, their preparer needed to include the transaction in capital reporting forms, even though the gain itself was excluded. During the standard review process that occurs when returns are matched against reporting documents, the IRS adjusted certain expense entries connected with the transaction. The adjustment changed how the income calculation appeared in the Social Security benefits worksheet used during tax processing. This example demonstrates how documentation and reporting accuracy can influence the final calculation even when a gain is excluded under existing law. Another example involves Thomas Green, who is 69 and lives in rural North Carolina. Thomas sold a house he inherited from his mother. He did not use that property as his primary residence. Instead, he lived in a mobile home on adjacent land. Because the property was inherited rather than used as his main residence, the home sale exclusion rules did not apply in the same way they would for a primary residence. The gain from the sale therefore needed to be evaluated using capital gains rules rather than the primary residence exclusion. Situations involving inherited property also include another important rule known as stepped-up basis. Under current tax law, inherited property usually receives a new tax basis equal to the fair market value at the time of the original owner's death. If that value is documented properly, it can significantly reduce the taxable gain when the property is later sold. Without accurate documentation of that value, the reported basis could be questioned during review. This example highlights why documentation such as appraisals or market analyses can be helpful when dealing with inherited property sales. If you currently own your home and have considered selling it within the next 2 years, it may be helpful to review a few key numbers. Do you know your approximate combined income using the Social Security taxation formula? Do you know how close your current income level is to the thresholds that determine how much of your benefits may be taxable? Understanding those numbers ahead of time can make planning decisions easier. Based on experience observing how returns are processed, several practical steps may help retirees prepare. First, before listing a home for sale or accepting an offer, calculate your combined income using the formula described in IRS Publication 915. Start with your adjusted gross income. Add any non taxable interest, and then add half of your Social Security benefits. This produces the combined income figure used in the Social Security benefits worksheet. Comparing that figure with the current thresholds can help you understand where your income falls within the existing ranges. Second, if you plan to sell your home during the current tax year, review the documentation used to determine your cost basis. Improvements such as a new roof, heating system replacement, major renovations, or additions may increase the property's basis. Increasing the documented basis reduces the reported gain if part of it becomes taxable. Receipts, permits, and county records can help support those improvements if documentation is needed later. Third, if your income increases significantly in 1 year, and that increase affects Medicare premium brackets in later years, there are administrative processes that allow individuals to request review when income changes were connected to qualifying life events. These processes typically involve submitting documentation explaining the change in income circumstances. Fourth, if you inherit property and plan to sell it, obtaining documentation showing the property's fair market value at the time of the previous owner's death can be valuable. This documentation establishes the stepped up basis used when calculating gain or loss. Even when the death occurred several years earlier, licensed appraisers can sometimes provide retrospective valuations based on historical market data. Another helpful step involves reviewing state and local property tax rules. Many states offer programs such as homestead exemptions, senior tax freezes, or deferral options that reduce property tax obligations for qualifying homeowners. These programs often require applications within specific timeframes after purchasing a new home. Checking the rules with a county assessor's office can help ensure that any available benefits continue after a move. If you work with a tax preparer, it can also be helpful to ask whether they reviewed the interaction between capital transactions and the Social Security benefits worksheet used during tax preparation. This worksheet requires information from several different sections of the tax return, and ensuring that all entries are accurate can prevent unnecessary adjustments later. If you prepare your own return using software, most major programs automatically run the Social Security benefits calculation. However, they rely on accurate data entry, particularly regarding the property's cost basis and improvement history. It is important to clarify that this information is general educational material rather than personalized tax or financial advice. Individual circumstances can vary widely, and consulting a qualified tax professional may help ensure that your specific situation is evaluated correctly. The goal here is simply to highlight how several parts of the tax system interact so that homeowners approaching retirement can review their numbers carefully before making major financial decisions. To summarize, the home sale exclusion remains an important benefit for homeowners, allowing many individuals to exclude significant gains from taxation. However, the broader financial activity reported during the year of a home sale can influence how other calculations operate within the tax system. Those calculations may include the worksheet used to determine the taxable portion of Social Security benefits and the income levels considered in Medicare premium determinations. Understanding these interactions allows homeowners to review their situation carefully before finalizing a sale. You now have a clearer picture of how these mechanisms work. You know the thresholds currently used for Social Security taxation, the forms commonly involved in reporting a home sale, and several steps that may help ensure documentation is complete. Reviewing these details ahead of time can help avoid confusion later when tax returns are processed. With that knowledge, you are better prepared to evaluate how a potential home sale fits into your broader financial picture during retirement.